And I've got to say, Howard, Rodney, it would not surprise me in the slightest if pricing is still very, very strong and going to get stronger, because the problem is not getting solved today. There is a requirement for a lot more lithium units in the supply chain than the supply chain can currently handle. Arguably, if the capital doesn't start to flow upstream at the right pace, pricing is only going to get more extreme and assets are only going to get more expensive.
Welcome back to Rockstock Channel, and thanks for checking in. Before we launch into the interview, we'd like to thank all our Patreon sponsors. And for those of you who are new, share a bit about us. RK Equity is an advisory firm run by Rodney Hooper and me, Howard Klein. We are exclusively focused on raising awareness about companies producing or developing the next generation critical raw materials that are powering Tesla's EV battery energy transition. Please register your email at rkequity.com and follow Rodney and me on LinkedIn and Twitter. Please also subscribe to this channel, Rockstock Channel, on YouTube, as well as Lithium Ion Rocks on SoundCloud for our podcasts. Please note, Rodney and me are not financial advisors or broker-dealers. Nothing you hear in this video is investment advice. Please do your own research and read the disclaimer at the end of this video or on our website. Thanks again for the support, and let's get into the video. I have Ken Brinsden, the CEO of Pilbara Minerals. I know you, 4 or 5 years ago when you were at Atlas Iron, and then I was aware of Pilbara early. I missed the stock when it was at 1 cent, 2 cent, 3 cent, all the way up to $1.25, at the previous peak. And now to see you, kind of north of $2 and north of 6 billion, market cap, 4.5 billion US. You've surpassed what Atlas Iron, achieved. In our opinion, we see you as the swing spodumene supplier. This time last year, I wrote a note, M&A life in Western Australia, with a vulture, over Altura. What was the final purchase price of that? I guess cash plus shares.
Yeah, well, the total consideration was about 240 million Australian dollars.
I want to talk about your joint venture, what's happening with POSCO on the downstream. How is lithium so different, from iron ore? You could see BHP and Rio Tinto earning, 65, 70% margins. Obviously, the iron ore price has fallen a bit, but for several years, just minting cash as major producers, and the steel industry is not, super exciting. A place to be, or with very high multiples. So why is partnering in a 30% JV position with POSCO so important? Why not use your high stock price, raise capital, and acquire more spodumene assets in the way that Ganfeng is doing, right? If you joint venture with POSCO, to some degree, you're competing with your customers. Skills are in short supply in Quebec, for example. Why not? Livent Nemaska would love some mining skill set, I would think, that Pilbara could potentially bring. Why is that not a better strategy, than the partnering downstream?
Yeah, no, look, I get the logic that you're exploring there, Howard, and I think the way to think of it is to say, at least in part, I agree with your thesis, but I don't agree in full. Our strategy is all about building a portfolio of sales channels and a portfolio of products, and we think that portfolio creates a much more flexible business over time. So the best example you have today is to say, well, isn't it fantastic being a merchant seller of spodumene? We are really going to have our day in the sun. The chemical conversion market is short. We have available spodumene. By implication, we should be able to maximize price in the value in the spodumene. And history dictates that that's not always going to be the case, and especially when your principal market is China, in which case we think about the growth of our business as being a portfolio of products, some of which represents merchant spodumene like it is today, great business, and we'd expect it to be good business for quite some time yet. But in the medium and the long term, there will be further cycles that support deeper levels of vertical integration and the ability to participate in multiple markets. And by that, I mean literally selling lithium products all the way around the world, not just to China, not just to POSCO in South Korea, but to Europe and to the North Americas, because they're all going to be important markets that are developing in the medium term. The truth is they're not available today, in which case you've got to find the other alternatives. And that's one of the reasons why we're looking to more deeply integrate with POSCO. Korea is the next big mover after China in respect of the combination of battery making capacity and cathode materials, in which case we love the idea that we can position our spodumene there and also win some of the economic margin that we'd expect to emerge once you're producing a very high quality fine chemical. So yes, I agree, but only in part that you want to be in spodumene. We'd say, yes, that's not a bad place to be, but you don't want that to be your whole business. You should think about a portfolio of products and sales channels.
Correct me if I'm wrong on this, is that like all of your product is going to Ganfeng, General Lithium, and Yibin Tianyi, is that correct?
Yeah, some additional shipments to Great Wall Motor Company and POSCO for the operations around their demonstration plant.
And what is the POSLX process? How does it compare to like Metsu Outotec, for example, is being used or contemplated by a number of Halmec, Piedmont, Critical Elements, yeah. Calibre. Is it a sulfate-free process, which is what Tesla advertised?
Yeah, their technology is very, very smart technology, and probably one of the few organizations that can pull it off as a function of the amount of money they've spent in research and development. But fundamentally, it's an electrodialysis process. So they're relying on a high current splitting a solution that pushes lithium ions in one direction and pushes the sulfur ions in the other. A couple of the key benefits are fundamentally a more pure product through that purification process. So we would say, really high quality outcome, and then the ability to recirculate your reagent load. Basically winning back the sulfur ions so that you can regenerate sulfuric acid and keep the process closed, minimize the waste, minimize the reagent inputs. And I'd suggest in the first instance, probably, a generation beyond that proposed by Nemaska up in Quebec. And I guess the benefit that POSCO had sort of working for them is the ability to spend a lot of money in research and development and several iterations of the pilot scale facilities and then the demonstration plant to lock down the process combination of cost, quality outcomes and the like. So yeah, so we're really happy to be aligned with with that combination of technology and strength in engineering. More broadly, when we think about what Pilbara might do next with its spodumene, it's not typically aligned with a model that you're going to ship your spodumene overseas, because we feel like that carries some penalties in the supply chain. So you don't want to be handing your customer a waste problem.
Why don't we talk a little bit about pricing and this BMX structure?
There is now a really big problem emerging in the industry. There is a lot of chemical conversion capacity that far outstrips the spodumene supply base today. They want to run because chemical prices are strong, in which case there is a transfer of value that's making its way upstream to the resource. And I've got to say, Howard, Rodney, it would not surprise me in the slightest if pricing is still very, very strong and going to get stronger, because the problem is not getting solved today. There is a requirement for a lot more lithium units in the supply chain than the supply chain can currently handle. And that means there is every chance that incentive pricing needs to go higher to get more production in the market.
We're seeing quite a discrepancy between contractual pricing, given that spot pricing for chemicals is moving so fast. So how does the industry better refine the formula is to narrow the volatility between what you're getting in contract sales and what the spot market's doing?
Well, the simple answer is, Rodney, that yes, we will put more product into the BMX sales channel. And the logic in doing so is that we ultimately want better price transparency, and the best way to do that is through a more accessible market platform. We expect that during the course of next year, we'll have about 200,000 tonnes, and maybe even a little bit more, depending on how successful we are with the optimization around our Pilbara plant, in addition to the Nagaju plant production. With respect to this disconnect between spot pricing and offtake pricing, of course we agree with the premise that if you have product in offtake, the expectation is it's a longer dated relationship. So it makes sense that there should be more stability there. But you need the spot market to define the relative position or the tension in the market so that you've got better price transparency. Now, the way that, we've deliberately done that with the BMX platform, and we're going to be, doing more of it. So the ability to transfer the effect of the market price via the BMX platform to our offtake agreements is now an important part of the future of the business. The good news is our offtake partners, they understand the dynamic that's in play here, and actually, arguably, it's kind of the completely reverse position to where we were in the middle part of last year before demand started coming back. Offtake agreements were difficult to get to stick, and we had to run the plant at a lesser production, even though we had more capacity. And we did our best to maintain relationships with long-standing customers, or people that we expected to be long-standing customers into the future. And it would appear that the reverse is equally true now. There's recognition from buyers that the circumstance that's arisen today does represent another extraordinary circumstance, albeit the other way. And they're concerned about their ability to maintain continuous supply. So hence we can have a rational conversation about some level of equalization in price. That means we should get a fundamentally better price for the product in offtake.
The concept of price floors was a good one, in the sense that it would ensure that new producers could survive and stay in business. But we saw that model fall over as chemical prices just couldn't hold and the guys couldn't carry that cost. So one of the things I guess one could consider is some kind of a futures exchange or a trading platform that's sort of longer dated than spot, where you have you can execute volumes and have some kind of a clearinghouse guarantee on financial performance. Do you think that's something that could possibly, take off and see spodumene concentrate rather than sort of a bridging between spot and long dated formula based, where you can get material out the door at a predetermined price so one can commit to expansion plans?
Yeah, I think that is a natural evolution for the industry, and that there will be. It'll actually become an imperative, because it'll become so obvious that there is a problem with the flow of capital upstream that people will naturally want to look for financial solutions to facilitate that trade. I think what's happening in the lithium raw materials world, and arguably battery raw materials more generally, is just a natural evolution of markets. And we want to make sure at Pilbara that we're sitting at the forefront of this discovery, if you like, hence the idea that we, if there's no platform available, why not go and build one yourself? Now we've taken the role of kind of first mover, but arguably, of course, people will want to follow. And actually, in some respects, we're incentivized to see that happen, because the more liquidity there is in these markets, the better the chance that you'll get financial players who want to participate, create the instruments that flow from that trade. It feels like this process is now, well, whilst it's formative, it's definitely in train. It's happening. And as to how long it takes, well, probably faster than most people think. I've just recently had inquiry about the potential of the SGX exchange in Singapore getting involved in the chemicals trade, and arguably even the spodumene trade. So yeah, I think, and the LME, of course, is doing something similar. I think it's just going to happen as a matter of course, because there will be more capital required upstream.
And I guess my angle on this is really, you have a clearinghouse so that there can be no, it's something interposed. You can't just suddenly have a change in circumstance and then things don't hold anymore. You're beholden through the clearinghouse, which I think is going to be the key element. So those names you're mentioning are good ones to do that. What do you think is a reasonable spodumene concentrate, let's say 6% price, that you can cover your costs and earn a decent margin and have the flexibility? What's the sort of industry-wide is your gut to keep growth going and keep supply expanding?
There's really 4 big meaningful mines: Pilbara, Wodgina, Greenbushes, and arguably Mount Holland. The combination of location, accessibility to infrastructure, quality in the resource, I think they're the big 4. But you're not going to incentivize them to continue to expand production unless pricing is probably north of $600 to $650 a ton. And they are the low-cost mines. So everybody else will require a price higher than that, would be my view.
So, Ken, if you look at chemical conversion, cathode and planned battery production, you just see, when you look at the benchmark with a cathode, it's just China, China, China. So it looks set that they are going to remain dominant in that area, but they don't have any meaningful spodumene concentrate or lepidolite feed supplier of their own. So if the market's going to move to something like, what you've got with the BMX, with the spot sales and a futures, is that such a bad thing? In other words, if the demand is in China, changing the way that the market supplies them could meaningfully shift the risk away from, a repeat of what we saw the last couple of years. So is that such a bad thing if you change the way you supply them, to have China still remaining a huge market?
More price transparency will create a better environment for the industry to be able to raise capital and establish meaningful mines that are supporting the industry over the medium and the long term. As it stands today, and based on actually our own experience, if the industry has to go through the experience that Pilbara Minerals went through, the combination of very, very high cost of financing and the punishing sort of downturn that took out some of our peers, you're not going to get any more new mines developed. There has to be much more sophisticated systems, and I'd like to think that in some respects we're providing a bit of a shining light there to say, well, look, here's some tools that will help the industry over time. And for Pilbara Minerals, we'd say, well, that's great. That's hopefully a great model. It's going to create a stronger industry over time, but geez, it'll be nice to make some serious money in the next 18 months or 2 years whilst the inevitable spike in pricing emerges.
If I can just chime in there, you just actually made me think about the link. Your BMX is like that transition when iron ore moved from contract pricing to spot pricing. The transparency that you talked about, which was good for the overall iron ore market for a period of time, and the iron ore price just soared enormously in a period of time where you had massive profits, massive enthusiasm for iron ore juniors, and we represented a few of them. Atlas bought one of our clients, Feroz. I do see something similar potentially happening here in the lithium market broadly, but in the spodumene market in particular, there's a number of new exploration companies coming out in Western Australia and Quebec. Chris Evans, ex Altura, and Winsome, but there's lots of spodumene in the world and lots of spodumene to be explored. And if prices are going higher from the 1320, which you just telegraphed, you think that they will, companies like Core, just to your cost of capital consideration, Core just raised equity, straight equity, fully financed. They're not going to experience what you experience, what Altura experienced with a super high cost debt. So the equity markets are open, they're liquid. Mineral Resources just sold overnight a very large block of stock in your stock. So while that's happening, I'm hopeful that more and more, the industry needs it. We just interviewed Red Spencer of Canaccord, and he's saying the industry needs $3.5 billion a year, money raised, in each of the next 10 years. So I'm hopeful, more of that will come. But I chimed in here because I'm making that connection. It's reinforcing those early years of the transition of the iron ore market from fixed contracts to, spot pricing. It was very exciting time, 2000, post-financial crisis, 2009, 10, 11, 12 were great iron ore years. And I think you will experience, it's only been 4 or 5 years here. Like you had 2 build years, 2 down years, but now it's harvest time. I went back and I listened to our interview 2 years ago, and we had talked about, everyone was talking about an oversupply. We called it an under demand in China, in 2018 and 19. And now you're talking about all of these converters in China, there's too much demand, but all of those converters in China 2 years ago were undercapitalized. But how did these converters suddenly, become so well capitalized to be ready, and good counterparties to purchase your spodumene? And to that point, we talked about quality. Yawa apparently has qualified into Tesla. I don't know if General Lithium has, how many qualified Chinese converters are there really, outside of, the Tangchis, the Albemarles, from Hard Rock, that could qualify into a Tesla, a BMW, a Volkswagen.
The chemical converters that are sort of deeply tied to tier 1 battery manufacturers, and especially those in Japan and Korea, you could count them on one hand. They are pretty much the old guard of the chemical conversion industry. And then you have the supply into what now would be viewed as being tier 1 battery manufacturers in China, like CATL, BYD. I think you'd find there would be levels of qualification. They may not be quite as stringent. Depends on the battery technology, but maybe not quite as stringent as through Japan and Korea. And then everybody else is probably serving, either lesser lights in the battery manufacturing world, or even other markets, maybe even ceramics and the like. So, yeah, so that's part one. Then part two to your question was, where did they come from? Despite the fact it was a tough couple of years, there was still capital flowing into the industry. So I'd highlight a couple of examples. There was chemical conversion capacity that had already been built really before the market had turned down, at least not in a meaningful way. So, for example, General Lithium, I'd put in that category. They built new hydroxide capacity, next generation plant, and it was really only being commissioned just as the market was starting to turn south. New players have come to the market, like Yibin Tianyi, who is very, very well funded in support of the CATL supply chain. So they were building anyway, no matter what the market looked like. Yongshan, similar deal, well funded by significant groups, building through the lowest of parts of the cycle, now getting set for commissioning. And they're not small facilities that they're building. They're pretty major capacity. So that's where the the bottleneck has now come from. They want to operate in support of more significant supply chains like CATL or Shanshan, and they want to operate because there's a healthy margin. Well, in theory, there's a healthy margin given that chemical prices are on a run. Rodney, I don't know if you're familiar with it. I just make reference to one of the futures exchanges within China, the Wuxi exchange. I don't know if you've come across that one. Yeah. Pricing is on a serious run there, and now moving into record territory, even for pricing in China. So there is some of what we've talked about already happening, albeit relatively small in scale, but nonetheless another data point to prove the evolution of the industry's pricing mechanisms is underway.
Yeah, I mean, what they've done is they've sort of like qualified or been very specific as to what that contract is, and then traded it, and I think that's fine. Within a range of it, you could still have sort of very specific metrics on the impurities, as you said. I don't think the grade, as long as the impurities sit within a reasonable range, the guys should understand what their yield will be of your material and what they can bid. So I think if you do that, you could have some flexibility as to, rather than being bespoke cargo by cargo, you could have a fairly longer dated contract going out on, say, your material.
Yeah, Rodney, if you're buying spodumene, you can take a view too on the spot market. And it just so happens that the guys who bought our cargo were absolutely right, because in theory, the people at the time might have thought, gee, that's an expensive, ton of spodumene. But the reality is, in the 6 weeks since we've run that auction, chemical pricing has run another, $6,000 or $7,000 well, $6,000 a ton. So they were right every day of the week back then. If you're buying spodumene in the knowledge that it's only going to hit the market as hydroxide or carbonate in 2 or 3 months' time, well, why not speculate that you can afford to pay a bit more for your spodumene, especially given the volatility of the lithium chemicals price.
Yeah, I mean, in that instance, you were buying in summer before we even get to the busy season. I do think that if you were to put parameters around that, you could do longer dated stuff, as could others. And so I'm looking forward, I guess, to seeing that, because it's on the basis of having, I think, a clearinghouse or a tier one, shall we call it, financial institution backing the performance, the financial performance when it comes time to buy, that guys will have the comfort to then go out and do the expansions and what have you. And if you've got a tier one clearinghouse, then the discount rate of what people will be prepared to fund you against that will be a lot lower. So we're going to see, I think that's an evolution that needs to happen.
The only thing that could spoil the party at present is Wodgina, coming on stream for spodumene, if that were to happen. Albemarle has controls that essentially, and said they have no interest in selling spodumene.
Yeah, far be it from me to tell Albemarle how to run their lithium strategy, but I do think it would be crazy if they sold spodumene, only to have that same spodumene ton compete with their lithium chemicals. I think the much more logical response from Albemarle is to control chemical conversion capacity in China so that they can feed downstream the spodumene. To me, that seems like a much more sophisticated and sort of more nuanced response to the current market conditions. That's the circumstance by which I think Wodgina restarts. So I think a tolling relationship is probably doable. And that would facilitate the spodumene making its way downstream. Actually, Albemarle have done that historically as well. General Lithium was their toller of choice over many, many years, Rockwood leading into Albemarle. So it's not as though it's foreign to them.
Any comments on, the cost inflation in WA and competition for workers and the like? And we have your guide, you put out guidance just a couple of weeks ago, the 2022 guidance, 395 to 430. You expect that to kind of go down to 340 to 375, but I remember the early days of financing the project originally, and the costs were meant to be somewhere between $200 and $300.
In the period of time since we first published a pre-feasibility study, about the time of the first reserve, the strip ratio has increased each time we've grown the reserve. And that's a function of most of the tons, not all of them, but most of the tons coming at depth as compared to near surface. So as you mine deeper in an open pit, it's almost inevitable. You will carry a slightly higher strip ratio. And that's meant that basically each time we print a reserve, we have printed a slightly higher cost. So in the period of time that you described, sort of going back to 2016, broadly speaking, life of mine costs have gone from just under $300 a ton to about 340 or 350 US dollars a ton. By far, the lion's share of that is driven by the strip ratio increasing as compared to sort of broader views around cost pressure. The current market for people is tight. We have some benefit in the industry we're in, so it's seen as being a new sort of growing industry. Pilbara has a higher profile these days, so that's helping us attract people. So as much as recruiting staff in the mining game in Western Australia is tough with all the borders closed, we're still able to get people, which is great. Contracting costs, yeah, bits and pieces of escalation and price pressure, but nothing like what we saw with the hyperinflationary environment that was in iron ore back in that period 2010, 2011, 2012. That was extreme. And WA was suffering from huge investment in iron ore production capacity, port capacity, and combined with oil and gas growth. So that was really painful. Whilst we've experienced a little bit of that similar pressure, it's nothing like it was back then, Howard.
Tangxi had this auction last year. Independence Group, emerged from it. There were rumors, BHP, Rio, FMG, maybe even Gina Reinhardt. There's a number of players in WA. Rio has now announced $2.4 billion. On Yadar. BHP and Andrew Forrest are fighting over a nickel asset. Battery materials is very much front of mind in a number of the majors in your backyard. But Gina Reinhardt invested in Vulcan, a DLE project. Where are these major players in Western Australia and iron ore? Why are they not in the game for spodumene? And do you think that they might, or they'll just maybe buy you?
Yeah, well, the majors have a dilemma, don't they? The idea that if they bolt on battery raw materials, does it carry enough scale to really move the needle? And I think increasingly what you're going to find is that philosophy changes, and it'll be motivated by two key drivers. The first is that there'll be protesters out the front of their AGMs, bemoaning their portfolio of assets that are all dirty. That might be one scenario. Another is that they'll come to appreciate that the new energy sector and the battery raw materials actually does represent the future of the mining industry and natural resources more generally, in which case they will have to get set at some point in time. And it's not going to go away, and the scale is only going to grow. And for all those reasons, I think you'll start to see them making more meaningful moves. Arguably, if the capital doesn't start to flow upstream at the right pace, pricing's only going to get more extreme and assets are only going to get more expensive. It's easy to imagine that at some point in time there'll be another cycle, but I don't know. It depends on whether supply can catch up with demand from here, I would say, Howard. And based on the current rate of growth, I'd say probably not. Consumers are genuinely switched on to the EV thematic now. I think you can see that in most markets around the world. And it's not going away. The car companies have finally worked that out, and they're now all starting to move in sync to build out more EV capacity and battery making capacity, but there hasn't been enough investment upstream, at least not yet.
So going back to your point that there's only 4 major mines, and the majors like BHP and Rio, et cetera, that's in their mindset is to go big. Perhaps there's some takeover premium being built into Pilbara's stock today above and beyond the forecasted EBITDA, because we were just doing some math versus your guidance, right, on 2022, and then we just over 23 and made some kind of forecast of what 2025 might be. If you're at 825,000 tons, call it, by 2025, and if spodumene prices are 800, you'd be generating $367 million of EBITDA. That puts you on a today 12 times EBITDA at a 49% margin. If prices are quite a bit higher where they are today in your spot market, it's more like 70% margins, and you'd be 6 times EBITDA, right? But that's where Rio trades, 6-7 times EBITDA, on where prices were a couple of months ago. But that's a today generating cash flow. We're talking 2025, and you're nearly tripling production in the form of that estimate. 3 years ago, you did not envision the downturn of 2018, 2019, 2020. Obviously you couldn't have predicted COVID. You're taking Altura off the market, definitely had an impact on the supply side. What could derail this? Right now we're all talking bullish again, so we may be wrong. So where could there be the hiccup?
I liked your analogy under demand as being a key driver in the second half of 2018, 2019, first half of 2020. China pulling the subsidy support for the industry, at least not to the same extent that it had been in the period from 2015. Had a really big impact through the supply chain, cash crunch, and as a result, demand dried up. People took advantage of stocks and the like. So, very painful period. Here today, it's a broader base of demand, and I see that as being really important. Key markets, ex-China, we're talking about Europe. North America is probably the next mover. Korea itself as a key supplier to the rest of the world. So it's a much, much bigger demand story. And the effect of COVID has brought forward demand that otherwise people might have seen in 2023. So the demand story is much more fulsome. So what impacts that? Well, I guess my view is that if there's enough chemical, then you'll see the spodumene prices moderate. But today there's neither enough spodumene nor chemical. So spodumene is going to, for the foreseeable future, it's going to drive the headline chemicals price in China, which is going to translate well to international chemicals pricing. That's the demand, or the pricing sort of dynamic I see that's probably with us for, at the very least, at least another 12 to 18 months, because there is no really material new supply that's going to hit the market in that short term. Altura is one of them, but that's, in the scheme of things, only a relatively small, has a relatively small part to play. Whilst Wodgina might restart, if, in my view, if there's a tolling relationship emerge, or they're able to somehow control maybe its ownership, chemical conversion capacity in China, then that might very well restart Wodgina. But Wodgina is not going to be a fast mover in restarting. Our experience would indicate it takes minimum 12 to 18 months worth of optimization to get it into a reasonable shape from a production point of view, especially the combination of production and quality. I feel like we're okay for a little while yet, and you'd like to think that demand is continuing to grow from here. I do believe that consumers are now switched on to the EV, and people have genuinely got to answer that question. If I'm buying my next car, am I going to hang on to my internal combustion engine car until I buy an EV, or I'm just going to buy an EV? I think that's almost to the point where the average consumer is getting.